Hello Trade Pros, this is Victor from TRADEPRO Academy, and today we're going to be talking about risk management, specifically the 90-90-90 rule and avoiding this category of traders. We're going to be talking about blowing up accounts and how we want to avoid both of these steps here. So let's get right into it. I hope you enjoy this video. So let's begin by talking about the 90-90-90 rule. The 90-90-90 rule is 90% of traders blow out 90% of their account within the first 90 days. So we're going to be talking about how we want to avoid that. And at TRADEPRO, we're pretty happy to tell you guys that we have developed a vibrant community that manages risk like no other. I just want to share a few results with you guys before we jump right into the rest of this risk management video. So I'm going to give you results for 3 months, the past 3 months, December, January, and February of our live trading room, where our traders collaborate on Discord and in our live trading room in the mornings on our webinar to turn market opportunities into profitability. So in December, we had 73% of traders go green and then 27% were down. In January, 71 up, 29 down. And then in February, we had 67 up and 33 down. So those are some pretty good results, but it's not a signal service, and all we do is talk about market structure, providing zones and all of that. And we preach risk management. So let's dive right into this video. So rule number 1 of trading is risk management, guys. You got to manage that risk, and the reward for that is profits. So first, you guys are risk managers, then the profits will come. The key is staying consistent. And how do we manage risk? We love to tell our traders that they should develop a trading plan and stay on top of that plan to stay consistent. So when you develop a trading plan, you have a certain list of criteria, a certain risk management parameter, a risk to reward ratio that you follow day in and day out, and you go through the trades that you only are comfortable taking. So whether that be pullbacks for newer traders or pullbacks, fades, and breakouts for the more experienced traders. Remember, keeping on par with that trading plan is the key to risk management. So to dive into that trading plan a little more, we recommend you guys backtest your strategies with your trading plan to make sure that that criteria that you've laid out works in the longer run. There's many backtesting tools out there, TradingView and Sierra charts for futures, but more on the 90-90 rule before we jump into more of the risk management stuff. So remember, 90% of traders blow out 90% of their account within the first 90 days. So if I jot down a list of drawdowns versus how much money you need to make in that account to come back to break even, the results are astonishing. So let's just do that quickly to show you some numbers, and we're going to continue. So now that we've listed increments of 10% drawdowns in your account, you can see the resulting gain needed to come back to that even level. So first, if you draw down 10% of your account, you're going to need 11% gain just to get back. Another number that might stick out here is if you draw down 50%, you're going to need to gain 100% of that current account balance to get back to even. And then following the 90-90-90, if we go into here, you can see if you draw down 90% of your account, if you end up here, you have to gain 900% of that current account balance to get back to zero. This number is massive. If you're running a smaller account, it might not be that obscene and crazy to do, but 900% gain on your current account balance is something crazy. So this is why we want to avoid the 90-90-90% rule, because it's very, very improbable that if you do draw down 90% of your account, you come back, and at that point, you're just 10% away from your initial starting point to blowing out your account. So we want to minimize that risk, and again, this goes back into risk management and our trading plan. So I'm just going to give you guys some quick tips, enough lecturing on how to manage that risk and how to avoid these 2 fatal trading mistakes. Number 1, of course, developing the trading plan. You're going to set a list of criteria that you're going to follow, whether it's stocks, options, futures, or Forex, and you're going to stick to that, and you're only going to trade that trading plan until you build consistency, comfort, confidence, and psychological well-being to continue and trade larger and make more gains. Number two, of course, is going to be follow that trading plan. You're going to follow that thing to a T, because that will build the consistency. It also helps a lot with your psychological well-being. If you treat every trade as a single trade and not as a potential drawdown or a potential win, a potential gain, or a potential loss, then you will be very sound in your trading emotions, your psychological trading, and everything in that nature. So that's the thing about the trading plan. If you follow it, you're going to stay consistent mentally and in your trading abilities. So if you follow the plan and you happen to lose a trade, it's okay, because if you continue consistently with your plan that works because you back tested it, then that trade is just another trade. You're going to miss a lot of opportunity, you're going to lose a lot of trades, but you're going to win a lot of trades. You're going to stay consistent. Under following that trading plan, a rule should be don't move that stop. You're going to have to use brackets, guys. Brackets mitigate risk. Once you enter a trade, you're going to have a stop and you're going to have a target. If you move that stop lower to accumulate more potential losses, that's not following your trading plan, and that's you blow your account, and that really messes with your emotions and your psychology, and it could throw a lot of your trading out of whack. And we want to mitigate all that emotion with our trading plan. So the only reason why you should be moving your stop is to secure more profits, which leads us into the trailing stop. So you guys can trail into profits and make sure they're consistent. So let's say you're trading futures and you're doing 2 lots. If you take profit at one level, you're going to trail that stop to a certain level so you can secure some gains, so your profit and loss isn't out of whack. Because at the end of the day, you want more wins than losses. You want a higher win balance than loss balance. If your whole thing is out of whack and you're taking full stops and not taking full profits, it really messes up your risk to reward and your win to lose ratio, and it can leave you consistently slightly negative each day. So remember, that has to be factored into your trading plan. Trade rule number 2, get paid. So whenever you have some kind of profit, remember, if you can disqualify the trade just because something's not looking right, it's better to get paid than let your stop get hit if you have some kind of profit. No matter how small it is, if you're consistently making small gains and no losses, that's great. If you have a large win, don't let that evaporate, just get paid. You can always look for another trade, guys. And this was Victoria with some trading tips for you guys, some risk management tips on how to avoid the 90-90 rule and how to avoid blowing out your account. So I hope this helped you guys. Again, Victoria from TRADEPRO Academy. Subscribe, hit that like button, comment down below what do you want to see next in terms of risk management, trading strategies, whatever it may be, and ring that little bell to notify you when we do go live every morning in our trading room. Join our community. It's risk-free. The first time you're going to get something risk-free in the market, we got a 14-day money-back guarantee. Come on over and see how the trade pros trade in the mornings. I'll see you guys next time.